Hi everyone and welcome back to the channel. So my account is sitting at 26,539 and I have an RSP which just holds American dividend stocks. So I do not have to pay 15% withholding tax, which is slightly in the green. And I also have a TFSA which holds a mix of both American and Canadian dividend stocks, and that one is slightly in the red. But overall, the income is still rolling in every month. I'm trying to build a passive stream of income to eventually replace my active income. And I've actually hit a big milestone. I now earn over $100 a month in dividends on average, which is a goal I set out in the beginning of the year for 2023. It was one of my goals. It was actually the final goal that I had to do for the year. So we've accomplished that. And now my new goal is to get $150 per month in dividend income. And I also recently got a sign up for WealthSimple trade. So somebody did use my referral link in the description below. So we did get an extra $5. So thank you very much for whoever signed up there. And if you want to get started using WealthSimple trading and buying Canadian listed stocks and ETFs with no commissions, just feel free to use that link below and I'll get something. You help support the channel and you can earn up to $3,000 just for signing up and making a deposit. All right, with that said, let's roll the intro and then get into the update. So in the TFSA, we're down like 1% or down 263 in the last day. Past week we're a little bit flat, just slightly up. And then if we look at the past month, we're down like 4% in a single month, so down 987. And then if we go to the all-time, just slightly in the red, but the market's been pretty volatile, especially this month. A lot of stocks are in the red, but I just see it as a great buying opportunity for a lot of high-quality stocks. So let's get into the buys and sells that I made this week. So I started out by purchasing one share of Aritzia. So there are a lot of question marks and fear around this company just due to a lot of macroeconomic factors that are holding down the stock from growing revenue and growing sales. But I still see that they have a lot of growth potential, and their capital expenditures have been pretty high in 2023. But now that their distribution center is completed in Toronto, that should lower their capex going forward, and we should start seeing a bit more positive free cash flow that we've been seeing in the previous year that we haven't really seen this year, just due to all the investments this company's making. So the thesis hasn't really changed. It's just this is a year of investment, and we're in a pretty tough economic climate for clothing retailers. So I'm just going to hold on to this one and just see how the story turns out by following those quarterly reports. And I'll definitely keep you guys posted on if I make any changes with Aritzia, if I sell any of it, or but right now we're just doing little buys. So I just bought another share of that. And then after that, I purchased one more share of Scotiabank. This has been in a very, very deep decline. And I decided that, let's just buy another, considering it was down like over 20% for me. So the banks are really hit by the high interest rates as well. And nobody really knows where the bottom is for these Canadian banks. There's a very real possibility that they continue to go lower. But honestly, I'm not scared. Like, I'm holding them for the very long term. From what I've heard, it does seem like, the bottom won't hit until we start seeing these loan loss provisions. You can kind of think of it like an emergency fund. So they look at their loans and they decide, which ones are a bit riskier, which ones they think that, the people will default and won't be able to pay back the loans. So they put that money away for the year. If it does turn out that they were a bit too conservative, I guess, in their estimates, or they overestimate the bad loans, and it turns out that a lot of them are repaid, then that money will come back out of the fund. It's just, anything unused will come back onto the books as profit. It's just a loss on paper right now. So we don't really know what's going to go on with the economy. A lot of people are thinking that there's going to be like a giant recession, but again, we've been waiting for this for several years. So, I mean, who knows? So that's one thing to watch for if you own any Canadian banks. So we're in a very, really high interest rate environment, and the loan loss provisions are still very, very high for the banks. So I think until we start seeing the loan loss provisions start to decrease, I don't think the banks are going to recover until that happens, because then people are going to have more economic certainty with the banks going forward, and that's why they're so beaten up right now. Next, I purchased one more share of CNR. So I am thinking that I kind of want to get a position of like 10 shares in total. So just slowly dollar cost averaging into CNR. The railroads have not been having a great year. In fact, a lot of them have been stagnant or slightly in the red overall for the year. But, you know, long term, even if like freight is down, in the short term, I'm not worried about several years out. I know that it's going to change according to the economy. So, and it's not like CNR stops making money in a down economy. It's still going to make good money. If you look at their earnings anytime, like over the long term, like they never have periods where like their earnings just decline and or get cut in half. So overall, not really worried with CNR. So we're going to continue the plan and continue to dollar cost average into that. And then with ENS, our Enbridge position, I just purchased 2 more shares, going up to 107 shares of this. So Enbridge has been really beat up, primarily due to the high interest rate environment we're having. The company does have a lot of debt as well, and people are scared by the acquisition they made for Dominion Energy. But again, they are buying assets at multi-year lows. It's true that they're using debt to fund it, and they are diluting shareholders a little bit to make that acquisition. But Enbridge does say that it will increase their cash flows, diversify their business. So we'll see longer term how this affects the business. And I purchased one more share of Granite REIT. So really liking this in the low 70s. So I just got another share of this, and of course getting as many fractional shares as I can, just with leftover money, trying to build this into a larger position. So this is coming along pretty well. Not worried about this company at all. So it's just real estate has been really, really hit in this high interest rate environment. You're going to notice this theme in basically the entire Canadian market where, you know, REITs are affected, banks are affected. I mean, even railroads to some degree, but not as much because they're not nearly as leveraged as telecoms or other sectors. And with Microsoft, they actually finally completed the Activision Blizzard acquisition. So this has been going on for what seems like an eternity. The deal is finally closed. So now Microsoft officially owns Call of Duty, and they own Candy Crush. So they're into the mobile gaming space now. So we're going to see how this acquisition does and helping their Xbox Game Pass service, because now they have a couple of more gaming properties, which they were really, really lacking good IP in that space. So we'll see how this affects Microsoft's bottom line going forward. But again, Activision is a cash flow positive company, so it should be immediately accretive to the shareholders. And depending on how Microsoft handles the company and handles the properties, they could do even better. So here's to hoping for a good, bright future with this acquisition. And then with Smart Centers, I purchased 2 more shares of this, going to 65 shares total. And this one's been beaten up, but paying a really, really nice yield right now. And the final purchase I made was TELUS. So I got another 4 shares of this. One of the shares I actually just used the dividend that TELUS paid me to acquire another share. So we're up to 81. And if you like the video, please leave a like and subscribe to the channel. And do feel free to follow me on my Twitter, where you can keep up with my little updates and any interesting news that I find in the stock market in between my updates here on YouTube. And then for my dividends earned all time, it's up to 1874.35. If we look at my projected annual dividends, they're 1222.87, so an increase from 1192. Monthly average just crossed over $100 per month on average, so from 99.37 to 101.91. Pretty nice progress there. And also the daily average went from 327 a day to 335 a day, so we're getting closer to our $4 a day dividend goal, which I have set since we crossed the $3 mark. So we'll continue increasing this by $1 over time. And, you know, just as we make our goals and cross them, we're always going to make new ones to stay motivated. And that's why I really like dividend investing, because you can kind of see the progress over time and it's not affected by the volatility of the market. You know, my portfolio going up and down in value doesn't really bother me, because what I'm really interested in is the dividend income. We can see year over year in 2021 we earned 261, 2022 is 743, and then year to date in 2023 we're at 868. So you can see, you know, every year there's a nice increase in the dividend income that we're receiving, and that's the ultimate goal, that this is going to continue to grow each and every year, each and every month, and it's just going to start growing at a faster and faster rate as the dividends start to snowball. And of course, my regular contributions are also going to play an impact in the portfolio as well. And if my portfolio were to work a 40-hour work week for me, it actually received a 2-cent an hour raise, so from 57 cents to 59 cents. Thank you so much for watching the video, and have a great day, everyone.